Welcome, everyone, to the Adjusted for Risk podcast here from the shores of Lake Tahoe. In this episode, I'm going to expand on my traditional deep dive manager analysis. In the past, I've gone ahead and selected PSN Top Gun award-winning manager, and I've done a manager analysis on it to see what it did well during the quarter, maybe what it didn't do well during the quarter, and just conducted a manager analysis on that manager. Well, maybe in light of the start of football season, opening weekend, I've decided to conduct a battle of two PSN Top Gun award-winning managers. So what I'm going to do is go ahead and take a look at two managers side by side, dissect their performance, and see if maybe there's one winner between the two of them. And in this edition, I'm going to go ahead and focus on the PSN large cap value universe and selected PSN Top Gun award-winning managers. The first manager is going to be the Federated Hermes Strategic Value Dividend Strategy, which is run by Mr. Daniel Paris since July 2006. The Federated Hermes strategy will be going up against the Morgan Dempsey large cap value strategy run by Mr. Mark Dion since February 2004. First, I would like to go ahead and congratulate both strategies for being named second quarter 2022 PSN Top Gun award-winning strategies. So let's go ahead and get started with this clash of PSN Top Gun award-winning managers. So let's go ahead and just start with returns. So when looking at trailing returns, it was really a story of two halves over the past 10 years. The Federated Hermes strategy got the better of the Morgan Dempsey strategy during the second quarter and over the past year to date 1, 2, and 3 year time periods. Okay. However, the Morgan Dempsey strategy has a better long-term track record as the large cap value strategy outperformed over 5 and 10 years. So it's also noteworthy both managers beat the Russell 1000 value index in every trailing period. However, the Federated Hermes strategy trailed the index over the past 10 years. So in the near term, over the last 3 years, Federated Hermes has had a fantastic run. Although when you expand it out to 10 years, that story is a little bit cloudier as the Morgan Dempsey strategy has outperformed over the longer time period. So with that being said, I prefer really looking at rolling returns as it removes recency bias from all the trailing periods. An interesting trend is uncovered when you're looking at 36-month moving windows. The Morgan Dempsey strategy outperforms that Federated Hermes strategy during every 36-month period going back to the beginning of 2018. So in a trailing periods, it's the Federated Hermes strategy that does well. But when you dissect those periods in the 36-month moving windows, that Morgan Dempsey strategy starts to outperform. Now, if you shorten those rolling window periods to 12 months from 36 months, that story is quite different. The Federated Hermes strategy outperforms in the recent periods, and that is really not a surprise when you consider this strategy outperforms quite handily over the past 12 months in 2 and 3 year periods. The Morgan Dempsey strategy does have better long-term returns, which is what we saw in the trailing returns. So it's not a big surprise. So as for alpha, over the past 10 years, the Morgan Dempsey strategy produced more alpha for investors. The Morgan Dempsey 10-year alpha came in at just over 4%. It was actually 4.13% compared to 2.37% for the Federated Hermes strategy. However, and this is a big however, the R squared for the Russell 1000 value index is very low for both strategies. The Morgan Dempsey has an R squared of 77.5, while the Federated Hermes strategy has an R squared of 67.44. So why is that important? Why should you look at R squared? It's very important to consider that when you're looking at any benchmark relative statistics. You also can look at the tracking error for both strategies is both very high. So the low relationship to the benchmark used, and in this case, the Russell 1000 value, must be taken into account when you're looking at statistics like information ratio, alpha, beta. These type of statistics are really only as good as the relationship is to the benchmark. And preferably when you're looking at large caps universes or categories, you would like to see that R squared at least higher than 80, 85, and even 90. You want a strong relationship there. Otherwise, if you don't have a strong relationship between the benchmark and the manager you're analyzing, then a lot of those statistics that are relative to a benchmark really they break down in terms of how useful they are. As for risk, there are a lot of ways to evaluate risk. You can look at volatility or the amount the monthly returns deviate from the long-term mean return. You can also look at capital preservation tendencies of a manager. Standard deviation is arguably the most popular metric for risk. However, it has some drawbacks, such as it includes good volatility or returns that are above the mean. Personally, I don't mind if there's if the volatility is high for those returns that are positive or above the mean. I'm more concerned about the bad volatility or the returns that fall below the mean. In today's environment where there is potential for a recession and potentially steeper sell-offs, I'm focusing more on preserving capital or looking at measures that focus on minimizing drawdowns or losses. Minimizing drawdowns will provide investors the ability to capture more of their recovery as it limits the losses today. So when looking for a manager who exhibits superior capital preservation tendencies during times like this, where there's potential steep drawdowns, I focus on maximum drawdown, number one, and the pain index. Since 2012, or over the past 10 years, Morgan Dempsey is able to do a better job of limiting losses. Its maximum drawdown was 15.76%. compared to Federated Hermes, which was 13.59%, while the Russell 1000 value index had a maximum drawdown of 26.7%. So not surprising, these drawdowns occurred during the peak of the pandemic, and for both managers, the drawdown lasted 3 months for both strategies. However, it took the Federated Hermes strategy an extra 3 months to fully recover. Okay, so that's pretty noteworthy there. Because it had steeper losses, it took an additional 3 months to get back to even. Taking it a step further and really looking at my preferred measure of capital preservation, which is the pain index, which measures all periods of loss, not just the maximum drawdown. So I prefer this measure, especially when there are a lot of uncertainties and risks that investors face that are out there in markets, really like what we're facing today. This is a more comprehensive look at a manager's capital preservation tendencies. Again, over the past 10 years, the Morgan Dempsey strategy did a much better job of limiting periods of drawdowns, with a 1.37% pain index compared to a 2.68% pain index for the Federated Hermes strategy. And when we're looking at pain index, we're measuring the amount of pain that a manager really produces for its investors. So a lower pain index, the better. That means it has less overall losses. The best pain index would be 0. That means the manager or the strategy hasn't had any losses during a specific time period. So now let's take both into account, return and risk, and look at risk-adjusted returns. And there really are a lot of metrics. It really can be alphabet soup here when we talk about metrics that measure a manager's risk-adjusted returns. I really feel, you don't want to, I like keeping it simple. So I feel there are 3 of them do a very good job of capturing how well the manager produces strong returns while limiting risk. And when you consider that the Morgan Dempsey strategy has done a better job of limiting risk, whether you look at volatility measures like standard deviation or downside risk measures like pain index or downside deviation, it should come as no surprise that the Morgan Dempsey strategy produces better risk-adjusted returns. So regardless, if you use the Sharpe ratio, which uses standard deviation as its risk measure, or Sortino ratio, which uses downside deviation, or the pain ratio, which uses the pain index as its risk measure, the Morgan Dempsey strategy wins across the board. Also important to note, the Federated Hermes strategy is really no slouch here either. Outside the pain ratio, this strategy beats the benchmark also. So both of them offer very attractive risk-adjusted returns. Lastly, let's go ahead and take a look at style. So both strategies are clearly stated as large cap value strategies. There's no confusion on what their stated strategy is, which is very good. And for some advisors and their clients, employing a style consistent manager is important. They want it to be style peer. So there's not a whole lot of overlap, and the correlation between all the other managers is higher. While others, it may not be as important. It may not matter to some investors or financial advisors if their advisors trying to find the most attractive values in the most attractive returns, and they have freedom to move across the style box. So when looking at returns-based style analysis, the Federated Hermes performance behaves very much like the Russell 1000 Value Index when looking at it over that 10-year time period. However, when you look at its style over 36-month moving windows, there are some 3-year time periods ending in 2017 when the strategy behaved more like a large growth manager. While the Federated Hermes strategy has a larger allocation to the large value asset class and has a strong connection to large value recently, it did experience some style drift going back in time. So meanwhile, the Morgan Dempsey strategy has been more style consistent or more style peer, and during all 3-year time periods performed very similar to that of the large cap value space. So I think it's fair to say both managers have done a good job of staying style peer, and I'm not sure those handful of time periods ending in 2017 would persuade me against employing the Federated Hermes strategy, because recent time periods, really since 2017, it has been very consistent in its style and behaving like a large cap value manager. So it's important to note, I just took a look at the quantitative approach to comparing these two managers. And it's equally important to take a qualitative approach when comparing two managers or one manager, conducting a manager due diligence, and so on. So I mentioned at the open that both portfolio managers have had a long tenure managing the strategy, and both have had a really strong run. But it's important to take a deeper dive into fees, the portfolio management team, how many analysts are on a team. Is there enough support to handle a big influx of returns? You might see, because of these strong returns, you might see a big influx of assets into these strategies. Are these teams set up to incorporate or take on a huge inflow of assets? Those are things to think about. A succession plan. What happens if one of the portfolio managers leaves? Is there someone waiting in the wings to take over? And the firm. Look at the firm as a whole. What type of commitment do they have to separately managed accounts? Or really, are they more focused on mutual funds and they're just offering a separately managed account? Look at the leadership of the firm. So there's a lot of things on the qualitative side that are worth looking into. So in closing, while the Federated Hermes strategy or strategic value has experienced really fantastic performance over the past 3 years, really particularly over the last year, the Morgan Dempsey strategy has a better long-term track record, both on an absolute returns basis and a risk-adjusted returns basis. So depending really on your preference when analyzing a manager, you may prefer the strong recent performance of Federated Hermes, or the stronger longer-term performance or track record of Morgan Dempsey. I think both strategies make a very compelling case to be part of a manager lineup. But personally, I would prefer the longer-term track record of success versus a shorter-term track record. Now, granted, Morgan Dempsey's struggled over the past quarter and year to date, but that longer term, over 5 and 10-year time periods, really is compelling for this manager. So with that being said, that concludes this battle of 2 PSN Top Gun award-winning managers. You can go ahead and go to a wealth of insight from 6,237feet.com, that blog, and you'll go ahead and find the show notes as well as the Zephyr reports that I use to go ahead and conduct this analysis between these two managers. You can get some further insights from myself regarding the economy, markets, investments there also. So with that being said, thank you very much. You can catch all of our other Adjusted for Risk podcast episodes on my Adjusted for Risk YouTube channel, as well as all your other distribution channels, whether it's Spotify or Apple Radio, to find this podcast. So thank you very much, and I hope you all have a great rest of your week. Thank you.